We want to talk about the economy today. We want to talk about the stock market a little bit, and we want to talk about issues that I think that you're concerned about. You've met our panel. Let me just turn right now to Lauren right here on my left. Lauren, tell us where we are in the economic cycle right now. There's a lot of debates about what's happening. There's a whole recessionista crowd out there that absolutely insists that we're going to have a much more serious economic slowdown and a job slowdown than the numbers indicate so far. Are you in that kind of camp? And just give us your outlook on the economy right now.
I do expect that we're likely to see the economy slow from here. And the reason and the legitimate model or framework that my team uses to track the economic cycle, something we call the economic dominoes. It's the idea that when the Fed or really any central bank starts raising interest rates, the economy tends to evolve in a similar manner over time. You tend to see liquidity sensitive and interest rate sensitive sectors struggle first. Areas like housing, for example, venture capital. Then the manufacturing sector flags. We've seen that for the last 20 months. And only after profit margins begin to compress, which we're starting to see now, especially as inflation moves lower, it's a little counterintuitive, but we are seeing profit margins move slowly lower. It's only then that you start to see the labor market and the consumer feel the impact. And we've seen those economic dominoes slowly topple over the course of the past couple of years. And so though myself and we were just talking backstage, my fellow panelists don't necessarily expect a severe recession, we do expect the economy to continue slowing. And that's an environment, especially as we begin a Fed cutting cycle, where portfolio construction becomes much more important.
Sarah, are you in the, I know she doesn't want to be labeled in the recessionista camp, but are you in the slowdown more noticeable? I don't see it in the data, but there's a small but insistent group of people who think it's going to show up. And so we analyze microscopically every weekly jobless claims number now on levels we never did before. Riff on what she was just saying.
At Nuveen, we are definitely cautious, Bob. There's three things that tend to drive an economic cycle. That's employment, consumer, and manufacturing data. So starting at the last one, manufacturing data, that has not been a strong driver of this economic cycle. Manufacturing data has generally been at or close to contractionary territory. Second is the consumer. That has been a big driver of this cycle. But if you look at the consumer today, delinquencies are picking up. Discounting is increasing. Second quarter earnings reports, consumer companies were very concerned about consumer spending. And then, of course, employment, that has been the bright spot in this economic cycle. But if you look at history, employment markets tend to crack right when a recession starts. So you cannot depend on employment telling you when a recession is coming. Now, what is employment telling us? It is slowing incrementally. So we have seen some slowdown in payrolls, employment data. And that gets us to the point that this cycle of high inflation and these interest rate increases will eventually hit the consumer and likely cause a mild recession. Our forecast is that happens sometime in 2025.
Brian, the recessionistas have been saying this for 2 years. They said it in October 2022, and everyone was freaked out and absolutely convinced. And if this is not a sure lesson about the folly of forecasting, I don't know what is. Where are you on this spectrum here?
First of all, Bob, I'm a bond manager, so I have to be in the recessionista. Okay. It kind of comes with the job.
I
wouldn't even have this job if I was
years.
not in the
200 years of
the glass is half empty camp. I would say this: deferred does not mean prevented. I think we have all become accustomed to. We've called them at TCW like these jump to recession scenarios. We had the GFC, Lehman Brothers collapse. All of a sudden, we're in a recession, and firms start firing people. We have COVID. We have a global pandemic, and all of a sudden, we've got this terrible situation, the economy shut down, and boom, we're in a recession, a short one. That's not the way it typically happens. Typically, in a traditional monetary tightening-induced recession, you get this rise in interest rates, you choke off the economy. It's effectively you are pulling the oxygen out of the lungs of the economy, and unfortunately for all of us that like to have our phones at our fingertips and see everything instantaneously, it doesn't happen instantaneously. And so typically in that type of monetary-induced recession, firms don't go from kind of hiring to firing overnight. They go from hiring to not hiring, and that is where we are. Basically, the demand for labor is flat at best. And we're in this market now where for pretty much the last 6 months, we've had anecdotes. We have anecdotes across the board. It's consumers and manufacturing all over the world that we are seeing the slowdown. And finally, in the last 60 to 90 days, we're starting to see the actual economic data start to catch up to the anecdotes. And I'm sure we'll get to the Fed later and interest rates. I'd say at this point, our view is that it's too late. You can't kind of turn this economy as quickly as the Fed would like, and more likely than not, we are heading into a downturn. And whether it's going to be a mild recession or a moderate recession, I think a lot of that's going to be determined by the Fed reaction function. How bad do things get? Does something break in the capital markets? And then how do they react from a rate and a QE perspective? That will determine how deep this goes.
And folks, feel free to jump in, so don't wait for me to look at you. Cool sunglasses. What did you just change? What?
So there's
With the movie star look
two
over
amazing
here.
things about this conference. One is that we get to talk about the future, right? Longer term issues. The second, and Dan Ives taught me this, is that you get to wear your best sunglasses.
Very cool. Don't wear the hats that or the shirts that
I
Dan
couldn't
Ives.
pull it off.
Dan Ives is here somewhere.
Full disclosure: Lauren is a USC grad, so she knows. She knows how to do it.
Fight on.
Excellent. Let's try to answer what the RIAs want to know about. Well, a lot of questions I had were on what to do with bonds, what to do with cash on the sidelines, with money market funds. So let's just start with the simple one, the 60-40 portfolio. Is it still appropriate? Give some advice on what they should be telling their clients when they get home.
I mean, look, 60-40 is as good a place to start as any. I think most investors use some derivative of that as their starting point. We do a lot of portfolio reviews and see that as a very good sort of base. As the Fed is cutting, and we can talk about 25 or 50 basis points, how fast or not, because what really matters is that the Fed is cutting. And after a couple of years where cash and cash-like instruments were pretty difficult to fight against, so it just makes a lot of sense to clip 5.5% off a cash-like instrument. Reinvestment risk is now an investor's biggest problem and biggest threat. And so as the Fed starts cutting interest rates, what we should all be thinking about is, first and foremost, what do you do with that cash to avoid reinvestment risk in a year's time or down the road? We are looking in the bond market. We really like short duration, investment grade, high yield, and even municipal bonds as a way to get back into the market at a maturity wall that we think is reasonable. But even thinking beyond that and thinking into the private markets, the Fed cutting is an incredible turning point in private capital creation. We're talking about how Fed interest rate hikes tend to constrain capital creation and slow the economy over time. Just this signal that we're moving in a different direction is already opening up deal flow. And so this is an environment where I do also expect certain areas of the private markets to be gaining steam as well. And so when it comes to the 60-40 portfolio, we're looking at balancing, for example, large cap equity, where we've seen a lot of the gains manifest over the past couple of years, with lower or middle market private equity as an opportunity to balance a portfolio, be creative within that 60-40 benchmark.
Sarah, I can't tell you how much our viewers love money market funds, love their 5% money market funds, love their ultra short-term bond funds. It is remarkably sticky. What do we have, $6 trillion of money market funds? And it ain't moving. And I keep wondering, well, gee, when is somebody going to do it? It's got to be 15%. It's got to be a little, unsticky. But they love it. Are they right to love it? I mean, there is a perception that they're getting a positive return. Inflation-adjusted return. Are they crazy, or should they be rethinking this?
Well, in our conversations with clients, there's basically been three main topics, and that's what's the right portfolio diversification mix, cash on the sidelines, what do we do with it, and also is technology and the tech sector going to continue to drive markets higher forever? So let's first start with your question, cash on the sidelines. People have been holding trillions of dollars of cash on the sidelines. Our concern is that as the Fed starts to cut rates, and I think we'll see that first cut this Wednesday, that return on your cash is going to deteriorate. And this is an opportunity to start to lock in returns that are higher than cash so they justify the risk that you're taking. So fixed income tends to outperform equities after rate cuts begin. So I think you can lock in high yields on fixed income at this point and outperform your return on cash. Portfolio diversification, Lauren mentioned that. Is the 60-40 dead? We saw in 2022 the 60-40 typical equity fixed income portfolio was highly correlated, unfortunately, to the downside. I think the 60-40 evolves to a 50-30-20, 50% equities, 30% fixed income, 20% alternatives. Individual clients wonder, how can I get access to these alternatives, these great asset classes, private credit, private equity? We're one of the largest farmland owners in the world. Farmland has been an effective hedge against inflation for decades. I think the last mile for asset managers is getting those alternative asset classes into individuals' hands so they can get less correlated portfolios and more diversification across the board, so years like 2022 are not as painful. Third topic, of course, is technology. When we look at this market, S&P at or almost at all-time highs, technology and AI has been the big driver of it since February of last year. Is this going to continue? Well, July 10th was a very important day because since July 10th, this has not continued. Tech stocks rolled over. Second quarter earnings reports came in and people decided they weren't good enough for the tech stocks that they owned. I think AI is here to stay, though. It's not going to replace human beings in terms of our jobs, but it is going to help us become more efficient. And for those thinking about another factor, which is the next generation wealth transfer, tens of trillions of assets moving from one generation to the next generation is going to be very involved in technology and how technology is used in portfolios. Their advisors need to be up to speed on technology. I think it's going to be very important for our clients and for advisors to be on top of those issues.
Can I just hop in for a second and make an addition? For those that are working with a 60-40 or 60-40 adjacent model, another way to think about what Sarah said, which I agree with, is that private equity is equity. Private credit is credit. Commodities or other sort of alternatives can be sourced from an equity or riskier allocation. And so don't feel constrained necessarily by 60-40 if that is the model that you and your clients have historically worked with. There are ways to think, okay, within the equity portfolio, how do we make the appropriate risk balance with, public large cap and private equity, for example. There are ways to sort of make the model flexible and take some of the ideas that we're discussing and work within it.
Let me hit on 60-40. So 60% bonds, 40% equity.
Thank you.
Right, thank you. Welcome.
Thank you.
I'm
Here's
going to
the bond guy.
I'm going to make the case. I'm going to make the case for bonds, but I just want to frame it out this way because a lot of things you'll read recently after such a strong run in interest rates is like, is there something left in bonds? How much is there to go? Have we run? I would say this. 3.5% to 4% on the yield curve, with the projection that the Fed is going to cut rates, and by the middle of next year, late next year, the Fed funds rate will be around 3%. I would say that is the soft landing right there. That is the soft landing. That would mean the recessionistas are wrong, because you're basically saying that the Fed is going to glide past this thing over the next 12 months and just land this bird perfectly at neutral. Okay? If that happens, your investment-grade corporate bond fund is probably going to return you plus or minus 5%. That's not bad. At the same time, like, bonds can still be bonds again in your portfolio. We're out of the QE, 0% interest rate era, which means that if the recessionistas up here are right, and this economy is actually slowing and it's going to have a more drastic downturn than we would argue probably is priced into most credit markets, whether that be equity or private equity or private credit, you got a lot more to go in bonds. You not only do you have that 5% coupon in your diversified investment-grade corporate bond portfolio, but the market now is overestimating or undershooting the amount of the downturn in interest rates. And so let's just call that easy. Just call it 100 basis points, which means, let's say the 10-year today shouldn't be at 3.5%, maybe it should be at 2.5%, and the 5-year around the same level. That means your bond portfolio is going to return you your 5% coupon, and then it's going to return you probably another 5% of price appreciation. So your bonds roughly are going to get you 10% in a recessionary environment, which clearly should offset some of that equity downturn in a traditional 60-40 bonds equity portfolio.
I want to just go back to Sarah's point of the 50-30-20. That's very intriguing to me. And as the stocks correspondent for CNBC, it does not make me very happy, frankly. But it's an intriguing idea with the alternatives. So when I was talking to RIAs here yesterday, there were two topics that came up, what they wanted to hear a lot about, and one of them was private equity and private credit. So you sort of opened the door for this. They want to know how they can get in. They're frustrated, you people are frustrated by the fact that the IPO market is not in great shape. Companies are staying private longer. And they hear about funds that are suddenly, Apollo, that are suddenly out there investing in this stuff, and they're not. And there's no way in. So you're very interested in how to do this. The ETF business is tying itself into a pretzel to try to figure out how to get in. There's some structural problems with why they can't, but let's riff on this. First off, how is private equity going to become more available? And answer my frustrating question, why the hell is it private anyhow? Why can't we get the private market to be more public? Where is this giant bottleneck, and why is it happening?
The bottleneck is in scale. When you're thinking about not necessarily the large and mega funds doing private equity, but your average private equity financed company, and most companies, if they are private equity financed, also are private credit financed. So we can open the door for Brian to add something later. These are founder-run companies for the most part. They have been involved in the business for decades, maybe generations, and the risk, both for the issuer and for the lender, of being sort of prone to the ebbs and flows of the capital markets doesn't make sense. But for a normal investor, and this gets at folks asking, why can't I be involved in this? Most people don't need their portfolio to be 100% liquid and available to them 100% of the time. And if that's the case, there is potentially some opportunity to use the private capital markets as a way to access some of this early stage, really interesting financing. But it is equity, it is credit, it is risky. And so the first thing that investors have to do is think very diversified. You're looking at, even small caps in the public equity indices are huge companies. You're looking at companies that are much, much, much smaller than that in middle market, lower middle market private equity funds. That's an opportunity that has to be diversified. Now, a way that investors can access a diversified opportunity like that is in something like an evergreen fund, which is not completely liquid, but does allow the opportunity for retail or institutional-like investors to get involved without being accredited in the same way that would be the case for a larger mega cap fund. And so I think the private markets are evolving, they are democratizing, but that diversification of the opportunity is so incredibly important, and understanding the role that it plays. Again, it is equity, it is credit, it is risky, and balancing a portfolio accordingly. That's why I mentioned earlier, we really like the idea of acknowledging that large cap equities, publicly traded equities, have likely a permanent fixture in most folks' portfolios. But when you look at especially the high net worth segment, these are folks that have started companies. They understand the middle market private equity opportunity in a way that is becoming more investable.
Sorry, Sarah, and anybody here, but are higher rates going to make it less likely that companies can sort of stay hidden longer? The funding gets more expensive, and there is an end game for private equity. They do want to eventually sell things. I'm just trying to figure out, it's really frustrating for me as the IPO guy. I cover IPOs. It's been horrible.
I'm going to tell you, so like, we cover consumers to the asset-backed market. We cover companies in the leveraged finance market, leveraged loan market, the high bond. I would say we have seen for the last 24 months, and it's ramping up at a non-linear pace. We are seeing the bite of higher interest rates kind of move up the economic food chain. It was the small, like, subprime borrowers, then it was the small and mid-sized companies. Now we're watching like mid to large size companies start to choke on these rates, because when you flip a switch on rates to 5%, guess what? Companies don't have to refi their debt right away. It takes years for that laddered maturity structure to roll over, but eventually it starts to bite. I do want to hit on private credit. So I'm going to take a couple shots at Mark Rowan, but I can do that for two reasons. One, Mark's traveled the world, telling everybody why bonds, liquid bonds are not necessarily, they don't need that same place in your portfolio. And two, he's a billionaire multiple times over, so he doesn't really care about what Brian Whalen thinks. However, I will tell you, like, when I look at the Apollo ETF that just got announced last week, and they're going to offer private credit to retail, to private wealth. I'm going to tell you two reasons to be concerned about that. One, the marks. I mean, when you hit a period of volatility, a recession or a dislocation in the capital markets, I'm going to tell you, my world, high-yield bonds, securitized bonds, like, that's hard to mark. A portfolio of private credit of these companies that, nobody's really underwritten, or a very few amount of companies, who knows what that's going to be worth? Even these, these pricing services that have the capability to underwrite it, they still don't know what somebody here is going to buy and somebody here would want to sell it for. And then the second thing I want to point out is liquidity. Right now, the Apollo structure, and you should read, there's a great article in Morningstar written by Brian Moriarty, who was a great dive on this fund. And he talked about liquidity, and right now the way that that fund is set up is that Apollo themselves seems to be offering the liquidity. And basically, so you've got the fund, and when it needs liquidity, they'll use the whole other universe at Apollo to provide that liquidity. So when you provide that liquidity with an environment where you have difficult marks on, personally, in my opinion, I think the loser is going to be the holder of the fund.
Well, but more concerning to me is, and State Street announced this fund, and a portion's going to be in private credit. They're buying it from Apollo, right? I mean, Apollo's going to set the marks, right? Well, doesn't that raise a little like
on that one?
Really? I mean, tell me what your concerns would be about that. That seems very obvious.
I think this is like, look, private credit's here to stay. Disintermediation of banks, that's not going away. Like, all of this is here to stay, but like, at some point, this kind of feels like, at least to us, like, you know, kind of classic late cycle behavior where, right, you know, the markets have been stretched and people see a great thing and it's had one hell of a run, and then the last one to get in typically is retail. But you know, these are structures and asset classes that have not really gone through a full cycle. So even when like we're investing in securitized, like I may like the receivable, but I want to see the structure go through a cycle and see it get bent and twisted and just see how it does. Right here at this point in time, to throw private credit into a structure like that we don't know how it's really going to perform in liquidity, that seems vulnerable.
Sarah, can investors get in on private credit, private equity without feeling like you're being taken advantage of what Brian was just saying there?
I think this is just similar to any asset class where you have to know what you're investing in and who you're investing with. I mean, what Brian just said, I could say about public small caps. I could say about public equities. You know, benchmarks, people investing in emerging markets benchmarks and not even knowing what they're owning. So in terms of private credit, you know, for us, it's about investing in quality, higher quality companies that can be resilient throughout a cycle, knowing the balance sheets of the companies that you're investing in. I agree, in private markets, you need to provide the returns that offset the risk that you're taking in terms of lack of liquidity. But within portfolios, similar to real estate, many people own a home. We know it's an illiquid asset class that you own, and you balance that with your public investments. So, you know, I think it's important to have a balanced, diversified portfolio in these other asset classes beyond equities and fixed income. And as Brian grew up in fixed income, I did grow up in public equity. So when I say I think public equities within portfolios will go from 60 to 50, it does pain me as a 29-year public equity investor. But I think it's important, though, as we see these public asset classes become more and more correlated, to have other alternatives. So I mentioned farmland, which is a large asset class for Nuveen. Over the past 20 years, it's beaten inflation on an annualized basis by about 8.5%. So in this new world where interest rates aren't going to be close to zero, we need to look for asset classes that can be more resilient in higher structural inflation, where I think inflation will stay at 2 to 3%. In a world where interest rates are not likely to go back to 0 to 1% rates, which other asset classes can we be thinking of? I think alternatives are going to play a big role. Now, the demand for them is not necessarily meeting the wrappers that they can come in. So it's about large firms. The bigger asset managers are acquiring these private credit entities, so it's not so fragmented anymore. And as we do that, we'll be able to bring those to clients either in their own vehicles or public to private vehicles. I think there's going to be a lot more interesting options than when I started in the industry 30 years ago, where you basically picked equities, fixed income, or you were a real estate investor.
Yeah. I want to move on. When I got here yesterday, I stood by the stage at 12 o'clock when it opened and asked as many RIAs as I could, what 2 or 3 topics do you really want to hear about? One of them was private equity and private credit. The other big topic was AI, artificial intelligence. Sarah mentioned this briefly, but I want to get a riff from the panel. And basically, the question I got, 100% said, we want to know how AI is going to impact our business. We want to know how we're going to use it. We want to know how it's going to affect how we do investments in general, the whole story about it. Lauren, just give us some thoughts here.
Sure.
And it's not, I'm not asking about AI investments, so like what's the new NVIDIA. I'm asking how is it going to impact the people out here?
I think that we are on just the beginning of what's likely to be a meaningful S-curve in artificial intelligence. So those who aren't familiar with the S-curve, it's a concept in business and technology where things kind of muddle along the way they've been going until there's a catalyst for change or an innovation. Then they change really quickly before leveling off. We're just in the beginning of that with AI. And so when it comes to the companies that have done well, these are the hyperscalers, really the infrastructure, the foundational layer of this technology. And so when it comes to how it will impact our businesses, the answer is we don't know yet. And this looked somewhat similar actually in the dot-com era, where there's a lot of excitement and some real meaningful change, the foundation of something really interesting happening. But it takes some testing, some ebb and flow for the corporate application layer of technology like AI to work. And I think we're just starting, after a year and a half of excitement around AI and the sort of barriers to entry being quite high, just starting to see the results of some of that testing. And so as we learn really how this will impact our businesses, that's when we'll see it broaden out in the financial markets as well. The small and mid-cap growth companies that are really taking on this corporate application layer, the infrastructure that will continue to need to be built both in data centers and in energy. But the answer in terms of how it impacts our businesses is that we are relying on these companies to figure that out for us, and I haven't seen the compelling use case yet.
Go ahead.
Yeah, I might just sort of 3 topics around AI. Number 1, it works off tons of data, which financial services does have a lot of that. Second is, how does the next generation that is inheriting these tens of trillions of dollars going to be thinking about artificial intelligence? And third is, what's the return on investment monetization? Starting at the bottom one, I think we have not seen yet the real monetization or productivity impact from AI across a broad set of industries beyond technology stocks. AI works off tons of data. We have tons of data on ranging from clients to how we invest. I think it's going to be an important component of financial services that we need to stay ahead of. And then thirdly, importantly, is the next generation of clients for financial advisors are going to be very involved, not only with their financial advisor, the way they consume information, so much more from social media, also very much engaged in technology. So I think we need to be able to deliver customized portfolios, deliver things on a digital basis, onboard clients on a digital basis, and make sure that we're using artificial intelligence to create the most diversified, least correlated portfolios.
I'll add, so how are we using TCW and how should you use it? I think of it this way. What's data intensive, labor intensive, a job you do not want to do because of those 2 things? And then finally, but it's still critical to your business. So the 2 ways we're using it, first of all, covenants. So we've gone through this period where like debt covenants, I call them Swiss cheese. You can get, borrowers can take advantage of you, and there's just so many different documentations, so many deals. So we've used AI to kind of pour through all those documents to kind of pull out for us kind of the risks out there, particular companies, and the levers the companies can have to work against the creditors that are at the end of the day our clients. And the second thing is regulation. Whether you're a bond manager, an RA, whatever you are out there, like regulation is foremost in our business. And so we use AI to kind of pour through the regulations to ensure a lot of the investments we're looking at are appropriate for the vehicles of the clients that are investing in them.
We're going to have to leave it there. I'm going to leave you one last thought about AI. There's a lot of concern about AI replacing people, including financial reporters. Yes, that is happening. But I wanted to know, you people, your jobs are very secure, because I ask people, what business are you people in? And they'll say, well, I'm a financial advisor, or I work on the desk at JP Morgan. I tell people, look at this in a much broader way. Yeah, you might be a financial advisor. You know what you're really in? You know what the business you're really in? You're in the dreams business. You're in the business of making people satisfied with their retirement, of putting their kids through college, of setting up a fund for their grandchildren. You're in the dreams business. And when you phrase it that way, suddenly your job becomes a lot more important and a lot more relevant to people's lives. You're not going to be replaced by any AI, because you're going to need, those clients need the, not just investment advice, but even the emotional support that somebody like a financial advisor can provide. And yes, financial advisors can be psychologists sometimes. I'm sure you all know that. So always remember that you're in the dreams business. You're not just in some boring financial services industry. For many, many years, I have written a blog called Trader Talk. It's the oldest blog at CNBC. I started it in 2007, and now it's part of CNBC Pro. I'm going to go back at 1:30. We've got a stand in the back, halfway in the middle there. Please come and find it. If you want to continue the discussion with me, I'm happy to do that. I feel very strongly about CNBC Pro. It's a great extension for CNBC. I'll be handing out ice cream. I know that sounds ridiculous. I look like a bartender more than an ice cream guy. Maybe we'll talk about a little bourbon on the side too, but it's going to be there. So come down at 1:30 and chat with me, and we'll have some ice cream and a nice discussion. Thank you, everybody, for coming.
Thank you
Remember,
all.
the dreams business, that's what you're in. Thank you, guys. Appreciate it.